Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about the statement of cash flows. We've talked about what it is, why it's important, what FASB hopes to accomplish with each statement of cash flows, the kind of information we can dig out of the statement, and most importantly, how do we create not a simplified statement of cash flows like we've done in the past, but an actual statement of cash flows with all of the different bells and whistles and requirements that FASB wants us to use. As part of that process of learning how to build a statement of cash flows, we talked about 8 different steps that we need to go through to build a full statement of cash flows. And so far, with our example company, Avery Arrowheads, we've done 2 and part of those steps. We started out figuring out the change in net cash for the year. We also set up our worksheets so that we were ready to put in information as we gathered the right cash flows, and then we started walking through actual cash flow adjustments. And that's where we are right now, going through special transactions that had cash effects or changed other important balance sheet accounts to see what the cash flow effects would be of each of those transactions. We're about 6 transactions into our special transactions, and we're going to talk now about a set of convertible bonds that were converted to common stock. On April 1st, year 6, the holders of $1.5 million worth of convertible bonds decided to convert. The conversion ratio was 25 shares of common stock for each $1,000 bond. And we want to know what the cash flow effect is of this transaction. So just like all of our other special transactions, we start out, is this operating, investing, or financing? And the answer is, it's none of them, because this is a conversion of bonds for stock, which means there's no cash at all. So our cash effect is none. There was no cash effect at all. Most people at this point would say, well, great, I don't even have to do this transaction, let's move on. But you can't do that for 2 very important reasons. First off, we need to know significant non-cash transactions to disclose them at the bottom of our statement of cash flows at the end of step 8. In addition, remember that step 5 will be to go through the balance sheet and look for any changes in balance sheet accounts that haven't yet been accounted for. If I don't make some notes right now about this special transaction, when I get to step 5, I may think that there's a cash flow effect because of the change in bonds payable or the change in common stock. So even though there's no cash transaction, I still need to make some notes here in step 3 so that I'm ready when I get to step 5. So because of that, we want to list our balance sheet effect. And before we can really do our balance sheet effect, we need to calculate some numbers. So let's do some calculations. And we have several numbers that we need to know. First off, we need to know the number of new shares that would be granted as part of this conversion. So to do that, we're going to take the 1.5 million divided by 1,000. That gives us the number of actual bonds that are being converted. And each of those bonds gets 25 shares. So we'll be issuing 37,500 new shares to these bondholders. Next, we need to know the effect on common stock. And that's going to be the number of shares times that $10 par value. So 375,000 will be our effect on that common stock account. Last, we need to know the effect on additional paid-in capital common stock. And this is a simple calculation. If I'm getting rid of 1.5 worth of convertible bonds, then I debit convertible bonds for 1.5 million. I credit common stock for 375,000, and the balance would go into additional paid-in capital. Now, wait a minute. What if there's a premium or a discount on these convertible bonds? That would change the calculation. And it's true, if there were a premium or a discount, I would need to account for that premium or discount as part of closing out these bonds. So I need to figure out if there was a premium or a discount, and the only way to know that is to take a look at either my financial notes, which I don't have because this is just an example, or the balance sheet where it would show me a little bit more about these bonds. So let's switch to our balance sheet, and under our long-term debt, which is where we'll find our bonds, and I see 3 accounts related to bonds. I've got a normal bonds payable and a premium or discount on bonds payable, and then I see convertible bonds. Now, normal accounting structure, the contra account appears directly below the accounted effects, which means that premium or discount is going to affect the bond payable and not the convertible bonds payable. Without any other notes, that's as close as I can get. But that's so common that anybody who knows and is comfortable with accounting could make that assumption and be okay. So in this case, that's what's happened. The premium or discount deals with the bond payable, not the convertible bonds payable. So I don't have to worry about a premium or discount. So let's jump back to our work. And with these numbers, I now know what's going on with my balance sheet accounts. I know I've got a decrease convertible bonds payable. I have an increase common stock, 375,000, and I have an increase to additional paid-in capital common stock, 1,125,000. And that's all I have to do with this special transaction because there is no cash effect, so there's nothing to put over here in my worksheets. The next special transaction is about our non-current investment. It says it represents 30% of the outstanding securities of the investee. This investment is accounted for using the equity method. During the year, we received $29,000 in dividends from this investment. Now, what is this talking about? Well, the best way to know what this is talking about is to jump to our balance sheet again. And what it's talking about is an investment. So that's going to be in the asset section. And specifically, it's dealing with an equity method investment. And that's this right here that's gone from 2 million to 2,121,000. So that's the account that it's talking about. And the question is there a cash flow effect? And if so, does it go in operating, investing, or financing? Well, let's go back to our information again. There is a cash effect here because we actually received $29,000 in dividends. So there is a cash effect, and the receipt of dividends is one of those transactions that, well, we think that would go in investing, but we moved it to operating to match the cash received from dividends with dividend revenue. So this is going to go in operating because it's dividend revenue. So our cash effect is $29,000. It's an increase because the cash came in. Now, what's the balance sheet effect? Well, the balance sheet effect is actually going to have two pieces. When we account for equity transactions, we always have to account for our percentage of their net income and the dividend that they pay us, unless they don't pay us a dividend, and then we don't worry about that piece. Remember, we're keeping track of our change in their retained earnings. So let's do the increase from our subsidiaries net income first. That would be a debit, my investment in affiliated companies. I'll abbreviate that. And my credit goes to an account called earnings from affiliates. At least that's what this company calls it. I know what the journal entry is going to look like. Now I need numbers. And I can find the numbers in the income statement because this earnings from affiliates is an income account. So if I go to my income statement, there's my earnings from affiliates, equity method, 150,000. So that's what goes into this balance sheet account. And we'll make this equal to that number. Now that I've done that journal entry, I can do the other necessary journal entry, and that's to account for the dividend that we received. So I had cash coming in of 29,000, and under an equity investment, I would account for that as a credit to investments in affiliated companies. Now I can figure out my balance sheet effects. So let's see. The cash effect I've already got, that's the 29,000. Earnings from affiliates is in the income statement. So we've got a debit to investments in affiliated companies and a credit to investments in affiliated companies, leading to an increase in investments affiliated companies of 121,000. And that's my balance sheet effect. Now, that takes care of my cash effect. It takes care of my balance sheet effect. What it doesn't keep track of is what goes into my worksheets. If this was an investing or financing activity, I would just put cash received as dividends, $29,000, and that would do it. But my worksheet for my operating section starts with my income numbers. And here's my number right up here, this 150,000. So what I need in my adjustments column is my change, not the actual cash amount. So the best way to figure out that adjustment is to look at the difference between GAAP and cash information. It's the same kind of adjustment and shortcut we were using when we converted from GAAP to tax. Why? Because tax law is typically cash-based, GAAP is accruals-based. So that same shortcut works not only to switch from GAAP to tax, it also works GAAP to cash flows because they're usually the same thing. Tax is the cash flow numbers. So let me draw this here. This is our net income number, and it's that $150,000. The cash flow is $29,000. So if I want to get from net income down to cash flow, I need an adjustment of $121,000 down. Now I'm going to stop right here for just a second. This is a really important method. It was important when we did deferred taxes. It's important here. It's the same method, same principle. I'm going from the accrual number to the cash number, just like I did under taxes, because under taxes, except for a couple exceptions like depreciation, we're being taxed on the cash flows. So it's the same exact method for the same exact reason. And that is another of our key concepts, that we can use this same shortcut for taxes and for cash flows because they're the same adjustment. So with that said, let's go ahead and put this adjustment into our worksheet. So right here, I'm going to have adjustment for equity method investments, and it's going to be a decrease of $121,000. Now, if you remember using the worksheet from earlier discussions of cash flows, remember the equation is that we take the accrual number plus the change in cash, and that gives us our cash flows. So let's go ahead and do that here, and we'll show how this works. If I take the 150,000 plus the 121, there's that 29,000 that's actual cash received from equity securities, or you could call it cash received as dividends. Either way, we're going to use this more formal title, but there's some flexibility there. There's that 29,000. That's what I wanted it to be. That's what it shows up as. And this shortcut shows how we get from the GAAP number to the cash or tax number. All right, we've talked about another key concept. We've done a couple more examples. When we come back, we'll continue on looking at our special transactions. More fun coming. We'll see you then. Thanks.